Start. Give it a second. Hello, everyone. Good morning, and thank you for joining us today. My name is PJ Daniels, who running from Deal Flow Events here, and we're putting together this panel webinar focused on going public strategies for biotechs, hosted by Deal Flow Events. Deal Flow Events, we've hosted a ton of events in person and virtually, covering a wide array of business and investment topics. And today's webinar will be focused on strategies for biotech companies looking to go public. Before we start, I'd really like to look ahead to some of our upcoming events taking place in the fall. October 20th and 21st, we're going to have our private credit sourcing conference, which takes place at the Hard Rock Hotel in New York City. This event really focuses on companies looking for private credit and allows them to connect with lenders, investment bankers, and equity investors at no cost. After that event, a couple of weeks later, we're going down to Florida, November 12th and 13th at the Hard Rock Hotel in Hollywood, Florida, where we're putting together the PIPES conference. So basically, if you're a publicly traded company contemplating a capital raise, or if you're an active PIPE issuer, you could join us at the event for free as well. I did put in the chat the 2 registration links for those events. So if you are interested, sign up for those while we're going through our discussion today. We expect this to run about 45 minutes, followed by a 15-minute Q&A. Then we'll wrap up at the end. I will be the main point of contact for the event. So if you have any questions or need anything, please, feel free to message me through Zoom or send me an email at pjd@dealflowevents.com. Now I'd like to hand it off to Steven Dresner, founder of Deal Flow Events, and who's going to be moderating today's discussion.
Right on, PJ. PJ, first, I just wanted to mention, I'm not sure if the links wound up in chat. So just take a quick look at that. On my console, it shows chat disabled. So at some point, if you can just pop, maybe there we go. All right, thanks. Looks good. So yeah, thanks again, PJ, for opening up here. I am Steven Dresner, your moderator for today's panel on strategies for going public with a focus on the life sciences sector. I expect everybody who's attending is going to get a ton of value from this program. We've got extremely experienced advisors on the webinar with us today. And for attendees who are really serious about this discussion, I strongly encourage you to reach out directly to our panelists. If you have questions or if you want to engage with them directly, we can help make that happen if you need contact info. And with that, let's dive right in. I'm going to do some quick intros just so we could save time here. We've got about 45 minutes of discussion, followed by some Q&A. Typically, we do look to wrap up at about an hour. If we've got a bunch of questions in the queue that we haven't gotten to at the hour mark, again, we'll just try to connect attendees up directly with panelists so that all questions are in fact answered. First, let me introduce Mitch Nussbaum, who is co-chair at Loeb & Loeb, where he's focused on representation of companies and investment banks on a variety of financial transactions, including SPAC, IPOs, PIPEs, and private placements. Mitch has been named as a top attorney in the area of corporate law and M&A by the Chambers Guide here in the US. And most people, I think, know he's extremely well regarded as an expert on SPAC strategies. He's got significant experience, not just with US-based companies, but also with foreign issuers who are interested in cross-border transactions. So it's great to have Mitch on with us today. Thanks for participating. Then we've got Rich Anslow, who is a partner at Ellenoff, Grossman & Scholl. And I've known Rich for probably 20 or so years. Rich specializes in securities law, M&A, and providing general corporate representation for not just public companies, but also privates. I think my background with Rich probably goes back to the emergence of PIPEs as kind of the dominant capital raising strategy for smaller cap public companies. Even maybe going back to the original implementation of Sarbanes-Oxley. So, I've got a lot of personal history with Rich. Rich has been involved in tons of PIPE deals, obviously, also well-versed in overseas transactions involving Asian companies. So thanks for participating, Rich.
Thank you, Steve.
And then last, we've got Mark Alenowitz, who's a veteran investment banker with deep experience in Regulation A, crowdfunding, private placements, and advising companies on all sorts of capital raising strategies. I know Mark to always be on the cutting edge of new developments in the capital markets, so I think he's a great addition to today's program. While Mark serves as an advisor to a number of companies, his main focus is as managing director of digital offering, which is a registered broker dealer. I'm certain that he's going to have a lot to add to today's discussion, especially when it comes to Reg A. So again, thanks for joining us today, Mark. Appreciate that.
Absolutely.
Let's kick things off. The object is we're going to make this, a roundtable discussion. We are focused on biotech and life sciences companies, but of course, there's kind of a more general aspect to what we're going to be talking about today. Wherever possible, I would like to keep it focused on the life sciences sector. But yeah, we're going to be talking about all different ways to go public, and probably other types of companies are going to be thrown into the mix, which is just fine. With that, Rich, why don't we get started with you? Maybe
Sure.
you could just kind of help us set the table here by talking a little bit about, why biotech companies might go public and when they start thinking about going that route.
Sure, Steve, sure. By the way, by experience, do you mean I'm an old attorney? I've been doing this for like 40 years. Okay, I'm the old man here. So anyway, all good. So listen, let's focus on biotech IPOs. Biotech IPOs, just like every other IPO, was very hot in 2021. 22, 23 kind of got very, very slow. But I think at the end of 24 and now 25, you've seen a lot more activity in the biotech IPOs. We were talking sort of when a bunch of us got together 2 days ago, we were talking about deals that have happened. So I kind of tried to do a little research over the last day or two. And what I found very interesting in the biotech IPOs that have occurred probably in, let's say, the last 12 to 15 months, you see a lot of smaller deals, sub 15 million. Then you see a lot of larger deals, probably 150, 200, meaning the IPO size, or even the value of a D-SPAC. And I find that to be very interesting. But I think what a lot of it is focused on is really the stage that the biotech company is at. I think that when IPOs now are recovering in the biotech space, I think that if you have companies that are really preclinical, maybe at a phase 1, phase 2, I think that's going to be a little bit of an issue. Maybe some of those companies get private financing before they decide to go the IPO route. But once you get a little bit more advanced, I think there is a real appetite right now. I'll turn it over to the other two guys, but the one last observation initially, Steve, that I'll tell you is that the areas that I've found within biotech to be very popular right now are oncology, obesity, and immunology. So those seem to be 3 areas. It doesn't mean that if you're in a different area of biotech, there's not going to be a possibility of doing a public offering, but those seem to be the hot areas right now. So that's my initial comments.
Yeah, to add to that, go ahead, Mitch.
Look, all I was just going to say was in terms of just, landscape, I think, what we've seen post COVID is there's no question there's been a downturn cyclically in the biotech market. And then, with the new administration, all the conversations about tariffs and price adjustments within the biotech world has, undoubtedly created a chilling effect to biotech deals, because it raised the levels of uncertainty within that market significantly. And I think that's what we've sort of been seeing if we look at the last few years, the years that Rich was just mentioning, and why we've seen a chilling effect. I do think that when you look at what's happening now, we are seeing that perhaps biotech is turning the corner, and reasons for that. I think number one, where we stand right now compared to where we were 4 or 5 months ago, is there seems to be less anxiety about the tariffs, in terms of where we sit today compared to where we sat in the spring. Again, is the uncertainty still there? Yeah, but I mean, the anxiety seems to have diminished somewhat compared to where we were several months ago, which I think is helpful to the biotech story. Also, anticipated lower interest rates can only help investments into biotech. It's always been a correlation between lower rates and better biotech markets. So I think these things are very relevant in terms of where the biotech market is, how it's turning a corner, and how I think that the street is taking a look at some of these ideas now in terms of deals going forward. I do want to agree with Richard wholeheartedly on some of the areas. I do think biotech is going to be more focused in certain areas. The obesity story has obviously been a great story. That story within biotech has sort of like continued despite the downturn. But I agree with regard to, in particular, oncology. I'll let Mark speak, but I'd like to get back to that because I think that there will be a significant focus on oncology for the next 10 years.
Yeah, I fully agree with that, Mitch. It's not just on oncology. I think what we're also seeing is modern medicine integrating AI. So we're starting to see more and more like digital health or wellness and integrating platforms and integrating the AI component to it in terms of being able to have drug discovery increase and become faster. And Rich had touched upon it. We're not seeing a lot of preclinicals. So the successful IPOs, and there's been 16 year to date, which unfortunately puts us on the lowest really point for IPOs in the last few years for biotechs. But I look at that as opportunity because we look for laggers. And when we start to see more and more oncology, we start to see wound care, we see med device, we see platforms, and then we see wellness and holistic medicine that coming together and then utilizing AI and other new technology. I think we're getting ready to see a big surge in the marketplace, and companies that are capitalizing on that and looking to enter the market. And as Rich also mentioned, be doing a private round ahead of it, getting capitalized that would get you through that phase 3, and then utilizing the public marketplaces to really take you over the edge. Those are ones that we're going to be seeing that success. So we see the small ones that have been coming out, we see the large ones, and then there's this void that I think now will finally be filled.
Yeah, Mitch, I don't know if there was something else that you wanted to add on your prior comments. I mean, I want to kind of dive into structures and, transaction strategies, but, I would be curious to get opinion on like the inflection points where a company that's got a clinical R&D heavy business gets clear indicators like this is the time where we should be looking at the public market. Like, is there, kind of, I don't know if I would use the word standard, but when you reach phase 2 or like at some point, is there like an obvious trigger point where companies are moving from a private capital raise to some sort of a going public transaction? Mark, you want?
Yeah, I can step
Was
in
that
on
to
that one.
Mitch? Oh, okay, go ahead. Go ahead,
Yeah.
Mark.
Yeah, I mean, I think what you have to look at is really it comes down to burn rate. If you have a high R&D cost, you're really going to need 18 to 24 months of cash, and you need to really see what that pipeline is going to look like and what the regulatory milestones are going to be. Are you looking for a fast track designation? Are you looking for a pivotal trial to start? Are you looking for upcoming INDs? All that plays into it, and then also being realistic on valuation. And are the investors willing to pay up for what you believe to be something big versus a reality check? And I think if you can tie in, and this is one of the things that we're starting to see more and more of, is strategic partnerships with big pharma, where you're collaborating on some of these new developments, or you're, and I hate to say it, going the VC route, because these VCs that you're working with have those connections and have the deeper pockets to be able to provide that strategic partnership. And we're actually seeing an M&A strategy where you can come in and start partnering with them and looking for other portfolio companies. So I think you need to look at what is your burn, what's the pipeline, and what's a realistic timeline to be able to start generating revenue.
But Steve, just to jump in for a second. So it's a very interesting thing when you talk about inflection point. So you don't know. So I talked about small IPOs and large IPOs, and let's say a company at the end of phase 2 or at the beginning of phase 3, and they could do a $15 to $20 million IPO. The concern I would have, not to say they shouldn't do it, and we spoke about getting into technicalities about at least raising 15 million, is that if they do the 15 to 20 million, they're at phase 3, but they really need $100 million, and they have a pretty high burn rate. They're not successful in the market. A lot of companies go public to raise additional money later on with secondaries, follow-ons, whether it's RDs, CMPO, registered direct CMPOs. And if they're not successful, they raise that 15, 20 million, they have a high burn rate. And all of a sudden now the stock doesn't do well and they can't raise additional money in the market, then where do they go? So sometimes the question could be, even if a banker is willing to get me public with raising 15 to 20 million, is it the right time to do it right now? But do I still get some more private money? So that's just one thing I wanted to touch on.
Yeah, and Mitch, I'd be curious, I know you represent banks that are doing these deals. So just kind of looking at it from the other side of the table, on investor expectations. I mean, has that changed in the past, 5 years since COVID? Sort of what are they looking for in these companies? Like, because like on the demand side, like has that changed in any way, or are they still kind of looking for the typical, inflection points through a clinical trial process and things like that?
Yeah, so I mean, I think that since COVID, what we have seen, we've seen a couple years of some sort of very active post IPO market, right? Because these, you know, a lot of these companies were running low on capital, and we saw, a very, very active sort of follow-on offering market, ATMs, pipes, a lot of RDs. We saw that for a couple of years, less, on the new issue. What I think we've seen over the last year is we've just seen several of these companies, just particularly on the smaller side, they have failed. I'm gonna be very, very honest, they have failed. And now a lot of these public entities are being sort of repurposed into other directions. I think as I said before, I think with lower rates, I think with a different outlook than particularly we've seen in the last year, I think turning the corner, we will be seeing new issue. And also what's going on is that the data that is coming out that those banks are looking at, that investors are looking at in terms of market statistics growth over the next 5-7 years is dramatic, right? It's dramatic. What I wanted to say about oncology in particular is that there's a lot of excitement there, just as there was, with the obesity in the past, because they're looking at a $340 billion market that will turn into a $900 billion market within the matter of X number of years, right? Like 5 or 6 years. That is what the outlook is for growth in that particular area. So right now we will see that'll be a story that sort of transcends a lot of these deals. I would say over the next year to 2 years.
Mm-hmm, mm-hmm. Okay, well, look, I'm eager to dive into actual strategies. Today we're mostly going to focus on talking about IPOs, talking about SPACs, reverse mergers, and Reg A. With that as sort of the backdrop, and again, just kind of thinking about things from the operator's point of view. Are there any particular market dynamics that a biotech management team should be watching closely over the next year and a half? Like, is there a more obvious fundraising strategy that seems to be, in favor in this sector? Something that, companies might be wanting to stay particularly in tune with?
I'll jump in for a second in the sense, Stephen, I'm probably going to turn it over to Mark with Reg A, because I think that may be one of the trends, and he can go into that because Mark does a lot of Reg A's. But listen, traditionally it's been, I mean, Mitch's firm and my firm do a lot of SPACs, and which leads to D-SPACs. I see some biotechs in doing D-SPACs. It's a little bit of a tricky vehicle. I don't see a lot. I still see more IPOs. And the traditional IPO obviously has been sort of the way to go to a certain degree for various reasons. We probably don't have enough time to get into that just in general. But again, I think that possibly because of the way Reg A works, the way you can go out and solicit, and Mark's firm has been very successful at doing that. I think that may be a path. And I don't know if Mitch and Mark feel the same way. I still do more IPOs when it comes to biotech, and also, foreign companies too. Like Singapore, for example, has a lot of biotechs. But if there would be a trend, possibly it's Reg A, but I'll let the other two guys jump in with their thoughts.
Right. Well, let's do this, Mitch. I mean, let's kind of start with IPOs. Maybe you could just walk us through like a typical process for a company that's planning an IPO. I mean, we start with IPOs and kind of move on from there, I think.
Yeah, I think happy to do that, but I think when you were talking about sort of potential pathways, what we're seeing a lot of, and what we've been involved significantly with, are frankly biotech companies that are actually using these digital treasuries, right? And I think that needs to be mentioned here, okay? And what we're seeing is publicly listed biotech, because we're talking about, but it doesn't have to be biotech, but we do happen to see a significant amount of these biotech companies because they're reaching for ways where they can raise, significant, capital for what they're trying to do. And so, what we're seeing is just an onslaught of pipes, very significant pipes, right? That have some sort of crypto strategy associated with those pipes. And whether that is acquiring a certain type of a digital asset, or people or holders of that digital asset converting that asset into shares of that public vehicle. So significant amounts of money being raised into those public vehicles, which then creates the issue of how is this company going to operate going forward, right? Is it going to remain a biotech company with all of this, sort of cryptocurrency, which it could sort of sell off over time and use the proceeds of that to be able to fund the biotech operations? Or are they going to spin off those biotech operations, into another public vehicle? So, I mean, I think that where we stand, this summer, I mean, this is like a real trend. This isn't like coming. This is happening, um, and and um, and so I think we see a lot. We see a lot of activity there. I want to be responsive to your question in terms of, the IPO. I think you're asking about the traditional IPO process, and you know there isn't anything new there. I mean, we're talking. You're looking at a situation where biotechs always seem to move quicker down the IPO path, simply because the issues with regard to financial statements and structure tend to be much simpler than other operating companies. And so, having audits, getting through a due diligence process is usually pretty targeted, right? Because you're looking at an intellectual property, you're looking at what they're doing from a labeling FDA process, and there's usually some scientific due diligence involved. Um, so you're looking at very targeted due diligence, financial statements that tend to be much simpler than other operating type companies that we typically do IPOs for. And you're looking at a process where there's an underwriter that gets engaged, an S1 that gets prepared, particularly if it's domestic. We can use a different form if it's a foreign issuer. It's filed with the SEC. It's usually like 3-4 month process, depending on how quickly companies can update their financials, respond to SEC comments, and so forth. And coterminous with that, an application process with one of the exchanges. I think the exchanges with biotech companies in particular do look at burn rates, because in terms of qualifying for those exchanges, they do look at where they'll be within 12 months. They certainly don't want situations where they're going to list them and then within 6 months we're already in a delisting process because they're already missing on certain situations. So there isn't anything new there in terms of the IPO process, the SEC process, the NASDAQ process.
But
And
Mitch,
Well,
can I pick up on one point
yeah.
before you jump in? Just one point. So you absolutely agree with Mitch, the process, but remember, more so NASDAQ than New York Stock Exchange. The New York Stock Exchange now has a $10 million minimum raise. So NASDAQ, there's three under NASDAQ capital markets. There's three different standards. One of them is the net income standard. And as we all know, biotechs don't have net income. So if you don't meet that net income standard, you now have to raise a minimum, or you have to have what's called the market value of publicly held securities has to be $15 million. And the way NASDAQ has changed the rule, probably, I don't know, 6 months, a year ago, to define that is that you can only use IPO funds. You cannot use selling security holders that are non-affiliates that register their shares. So again, going back to when I talked about these smaller IPOs, whether it makes sense for a biotech, and when they do it, Steve, on the inflection point, they'd have to at least raise $15 million to even be able to do a NASDAQ IPO because they do not have any net income. But anyway, it's sort of picking up on what Mitch
well,
said.
it's the 15 million plus they have to be
Yeah.
prepared for the shoes. So that could be
Oh,
like,
absolutely. More.
so now you're
Yep.
looking at right now 17, 18 million. And when it
Million.
comes to the smaller end of the IPOs, that's a
It's a
challenge.
challenge. Yeah. Big challenge.
Especially in this market. I mean, we're not seeing a lot of those larger IPOs. But one thing to add to this conversation is it's not just the process of going through the filing and going through the application and now raising a minimum, really with fees and everything, it's closer to 18 million. But what you also have to think about is it's gone from being a issuer-driven marketplace to now an investor-driven marketplace, where a lot of the small cap investors or funds and people that played in this space are no longer willing to take too much risk. So deals have become now more structure in nature. And what I mean by that is there's warrants and sometimes pre-funded warrants and other warrants that are attached to it. So it's no longer just a straight common stock deal. These structures are becoming more complex. And as Rich had mentioned, if these companies come public and you don't raise enough money, then in time, you're going to need to go back to the capital markets and raise additional capital. So these warrants sometimes have reset provisions and other things that goes into this toxic cycle where it's a constant down round. And we're then seeing these companies continually raise capital as their stock price goes down, and eventually to a point where it goes below $1. And at that point, your NASDAQ changed the rules where you can only have a certain number of reverse splits. So it's coming into this cycle that just is never ending. So you really need to think about, is it enough capital with that 18 million to be able to execute your plan without really having to go back to the capital markets, or the pro players are going to recognize that and really push on your stock?
How about the time commitment? Historically, we here at Deal Flow, we always kind of would compare a traditional underwritten offering to, more short paths like a reverse merger into a shell company. We would, identify you have the underwriting risk, markets change, pull the deal, and all that. But we also always kind of thought about the IPO as being burdensome on a biotech or a company management team. Is that really the case? I mean, if you're going to go public and you got a bank willing to underwrite the deal versus the team that could do, a de-SPAC deal or some reverse merger, I mean, should that weigh on the considerations of a team, like how much
No,
time it's going to? Yeah.
I think the game has changed there too, right? You used to see deals go into reverse mergers and look at that as a much quicker way of getting it done. But then, like, a year ago, the SEC changed the rules there too. So you're looking at having to go through a whole S4, process, because it's an investment decision now made by the public shareholders in the public vehicle. So now what you're seeing, whether you do a reverse merger, whether you do a SPAC, whether you do an IPO, you've got a registration statement with audited financials that you have to go through the SEC process. Either way you go, right, to get there. So, I'm sure all of us remember 15, 20 years ago when we had a whole bunch of reverses onto OTC vehicles with an uplisting and so forth. And that used to move incredibly quick. And we saw a lot of biotech companies avail themselves of that rapid approach, but that's not the case anymore.
Yeah. Steve, those were the days of your old reverse merger conference. Those don't happen anymore. Remember, we had the pipes in the reverse mergers. And as Mitch said, it's probably more than 15 years, but let's just say it's 15, 20 years. I want to feel younger. But those reverse mergers into OTC companies don't happen. Technically, a de-SPAC is a reverse merger. But as Mitch said, you still have to do your S4, F4. It's still the same process to a certain degree as the IPO.
Right. So let's transition to SPACs. I mean, Mitch, why don't you just sort of like set the kind of framework for, a typical SPAC transaction from the initial going public filing, to the de-SPAC, keep it high level, doesn't have to be specific to biotech, but just sort of like an overview of that process.
Well, let's talk high level in terms of what the advantages and disadvantages or the challenges are with regard to the SPAC structure. The SPAC structure allows that target to have some certainty that a deal can get done. The biggest problem with the IPO process, particularly for biotechs, is they are now committed into a very extensive process for what could be 6, 7, 8, 9 months. I mean, let's be honest, bankers are very enthusiastic at the beginning of the process as they get signed up into the process. Everyone tells the client how terrific they look, how beautiful they are, how wonderful this deal is going to be, what a home run they see this thing to be, and they get signed up on an exclusive basis for a period of time. And now this company is signed on to an exclusive banking arrangement, right, for whatever period of time has been negotiated. And then as they get into the process, into months into the process, the next beautiful prospect has shown up, right? This is the fear, tension's diverted, and you don't know whether you're the prize anymore and whether your deal will get done. And, listen, there's a tremendous amount of pressure in terms of having that capital needed to be able to go through the process, whether it's clinical trials or whatever the other development, depending on the life science company that we're talking about, and sort of sitting there in no man's land, not necessarily sure whether the market's committed, the bankers are committed, the funds are committed. It is a scary place for these biotech companies to be, right? So what the SPAC does, the advantage to the SPAC is you have a sponsor team who are also under significant amount of pressure because their SPAC liquidates in 18 to 24 months. They have to get a deal done. They're signed up on a definitive business combination agreement. They are committed, so you do have a committed party, and that's enticing to a biotech company because at least you've got a committed party with which you can transact, and it could result in a listing, right? On a listing, on a public listing, and all the benefits that come with that. The problem is with the SPAC product is that we're facing, and it's not changing. I don't see it changing in the near future. 90-something% redemptions, right? So this public SPAC that has like 200 million, 100 million, 250 million, whatever, by the time they get to the closing, they have like 500,000 because of the significant amount of redemptions. And then, of course, over the course of the transaction, there's transaction expenses, there's all kinds of professional fees, banking fees, and so forth. So are they raising money or they're going backwards? That's the whole question. Where SPACs have been successful with biotechs, and there have been moments in time where SPACs have been successful for biotech companies, is when you're able to put together sponsor teams that have credibility in the biotech world with a particular portfolio company, and when these sponsor teams actually have funds behind them. Okay, and we've seen these situations where you actually have biotech-oriented investors put up their own SPACs, or biotech veterans that have a tremendous amount of track record put up SPACs. They go find a technology to merge in, and then they have a sort of some support into the transaction. There are sort of I would classify I could classify SPACs in a lot of different categories, but for the purposes of this conversation, I would highlight the difference between a supported SPAC and a non-sponsored or non-supported SPAC. So in other words, what I mean by that is a SPAC, a de-SPAC transaction where there is financial support into the transaction, as opposed to those that are just, putting a deal out, hoping that the market's going to respond. The second one has not actually been very, very helpful for biotech companies. While I would say we have situations where the first have been, where you have that level of sponsorship. So not only do they get the listing, but they're going into it with some level of support. And I think that's where we've seen, in particularly in biotech, as opposed to other areas.
Yes, Mitch, a quick follow. Hold on one sec, Mitch. A quick follow on that. So, with regard to the SPAC team and recognizing, your best outcome is likely going to be working with a team that's got, ready access to privates that might want to, be part of the D-SPAC. What is the current, I guess, I don't know if I'd say SEC position, but, one of the things that I was always thinking about with SPACs is, you've got a private equity sponsor that, probably has a decent sense of what companies, maybe even in their own existing investment portfolio, might be a viable D-SPAC candidate. Is that workable? Like, are there deals where you see like a sponsor team bring a company into the SPAC where you could kind of say, they probably knew the company before the registration, like,
Be careful there, Steve. Be very careful as Mitchell jump in. You cannot predetermine that. But anyway, go ahead. Finish what
yeah,
you're
well,
saying.
that's kind of my question is like, it seems to me like with the SPAC deals run by sector-specific investors who have a mandate to get a target in that sector, it just feels to me like you're probably going to get the best outcome there, but is it okay for those sponsors to dive into their own portfolio companies to bring one of those deals public? That's really the question.
Yeah. So let me I'll try to answer your question generally and then get into biotechs more specifically. I think, Steve, what you're talking about is sort of a trend that we thought was going to pick up, and others thought was going to pick up some momentum, which was like sort of like the private equity based sponsors, and that there was going to be some transformation or transcendence from the private equity world into solving some of their issues with regard to lockups, liquidity, and so forth, and being able to transcend into the SPAC world by having SPACs set up by private equity, active private equity sponsors that could de-SPAC with, whether it was portfolio companies or not portfolio companies. I would just say companies areas in which they have familiarity with those industries, the players in those industries, they would be a blank check. There wouldn't be any negotiations or discussions with prospective targets, but they have a tremendous familiarity with that industry space, given that's where they're investing. And there was a lot of momentum into that idea, I would say, 5 years ago. Where has that gone? I think it's sort of diminished after 2022, right? I think there was a lot of enthusiasm about that strategy from 2020 to 2022. I think it's diminished significantly since 2022. Why is that? I think that the answer is because what we have seen was that a lot of these private equity sponsors just sort of looked at the post de-SPAC market values, after 2022. They saw a significant, decrease in post de-SPAC pricing or values after 2022. They lost a lot of enthusiasm for the SPAC as a solution, for that solution, right? Now, there's a whole conversation why maybe that way of looking at it is completely misplaced if you really understand SPACs and so forth. And that's the reason why the activity that you see in SPACs are not actually private equity sponsors. They're actually SPAC savvy sponsors who understand, how to get these deals done, and they have different level of expectations. Taking all that into account, let's go back to biotech, because that was the topic here. So, biotech tends not to be as much of a private equity space as much as you could have, sort of funds that are industry-focused biotech funds, right? I still think that there will be opportunities for some of these. We've worked, for example, with some of these biotech funds that have actually set up their own SPACs, and use these as opportunities to attract transactions that they probably couldn't have gone on, into their fund on a private basis. And we I think we had a really nice run of that, like, in 2020, 21, 20. Again, we've seen a slowdown because of some of the other macroeconomic, biotech, macro factors. I wouldn't be surprised if we see that come back in. But again, with biotech, it cannot be an orphan SPAC, because otherwise these guys just, this is not providing the solution that the targets are looking for. Yes, they'll get a listing, but they can't afford the process. They can't get saddled with the liabilities of the process, right? So they need to have something that is going to sponsor them at least for 6 to 12 months through the business combination, getting the expenses taken care of, a certain amount of working capital until they can get to a follow-on offering and so forth.
Mm-hmm. So, I'm watching some of the Q&A, and we have multiple questions on direct listings. So we were going to kind of downplay that, but we're going to have to talk about that in a few minutes. Just in terms of kind of wrapping up the discussion on reverse mergers, Rich, before it sounded like you were, of the opinion you're not really seeing the traditional, I'll call it shell merger that we did 10, 15 years ago. So for a biotech management team, is the idea of, looking for like a shell, not a shell with cash, but just like a shell, and putting together that, what was the typical shell transaction with a concurrent pipe, is that sort of off the table? And when we talk about, like reverse mergers as a nomenclature in the business, are we really talking about more de-SPAC, merging into?
Sure.
Yeah.
So what I would tell you, Steve, I mean, again, we can talk about direct listings on the side, which was a question. We should get to that in Q&A. But to me, I'd focus, and Mark could still jump in on Reg A, the IPO, and really the de-SPAC. And what I was talking about was back in the day, it probably goes back 15 years, when the OTC markets, the pink sheets became the OTC markets. As Mitch had touched on, it was a typical reverse merger that could be done with what was called the Super 8K, and you didn't need SEC review. So that's why it was very expeditious, and that's why people like to do it, especially a lot of these foreign companies, whether it was biotech or not. You really don't do that anymore. And no one really wants to go into an OTC company. There's many issues. That's a whole nother discussion. But what I would tell you find, I'm not going to call it a needle in a haystack, and people still call it a NASDAQ or NYSE shell. You do find those NASDAQ or NYSE companies, I'll call them orphans. They should have never gone public. They don't want to be public. They can't afford the expense. They've never taken advantage. And not just even foreign companies, I have some domestic companies who went public, and the goal for a lot of companies going public is to raise money after to build your business. They never access those markets. So now they say, you know what? I don't really want to be public. And somehow it is a little bit of a needle in a haystack, Steve. It's not like we know the SPACs that are out there that are looking to de-SPAC, but you do find those companies occasionally. I get phone calls on both ends. And so let's just call it a NASDAQ. Let's start with a NASDAQ company that now wants to basically spin their business out. They no longer want to be public. And again, let's talk about a biotech that then can go into that public company. So you occasionally see that reverse merger. It's very rare when you can do that, but you still, sometimes there's a process of you acquire, let's say, less than 20% of the company with a certain type of structure. Then you go up until you have to really get SEC and NASDAQ approval, but you don't see that often. And then it sort of goes back to what Mitch said. If you're now going into this public vehicle that has significant expenses, legal, accounting, et cetera, okay, and there's not enough capital in there, I don't see biotechs doing that as much as maybe other companies that just want to go public but have the cash flow. So that is a way to go, Steve, but the real issue there is, can you find even like a pipe in a situation like that, like you would in a de-SPAC? That would really be the key thing. So I don't see that as often.
I would just kick in, and I do think we should leave Mark with some time talking about the
regulatory
process. I do want to kick in and just talk about a very practical aspect with the reverse merger, which is that in today's marketplace, it'd be hard finding a vehicle for a biotech company because you're up against the crypto guys, and they will pay anything for the shell or whatever they can get for the shell because there's so much capital flying in, at least right now, right?
Yeah.
That could change in like 2 or 3 months. But where we are right now is the cost of these vehicles have gone up significantly because of the demand associated with these crypto, these digital strategy transactions, and you can't compete with those guys, right? So
Right.
you're either doing a deal with those guys or they're doing the deal
Mi-
without you. So
Right.
Mitch,
anyway,
they're buying sponsors. They're paying one of my clients. They're giving them $2 million over their expenses just to buy the SPAC so they
that's
can
the
merge the
that's
crypto company in.
that's
That's what's going
that's
on. But
that's
anyway,
what's
on to
crazy.
Mark. On to
Mark.
Mark. Anyway.
Yeah.
Yeah.
Yeah. Let's
Reggae.
Yeah, let's
Yeah.
dive let's dive into reggae. I mean, I know reggae primarily is a strategy where consumer-oriented companies, they have kind of an affinity product service where your investors could be company advocates. That's how I've always thought about reggae, with more businesses that just resonate with consumers. But
Yeah, we
Mark,
got to
maybe
change that view, Steve. I don't think you guys really understand reggae.
Yeah.
That's
So well, why don't we start there? I mean, a lot of people are unfamiliar with reggae, toward a public listing. So why don't you just kind of give us the rundown?
So here's the quick tutorial on going public. Securities need to be registered. There's what's called registered or exempt securities. What we talked about was an S1, which is a registration. Reg A came around in 2015. We went to the SEC and to actually the NYSE, and we said, why can't we use Reg A as kind of a quasi form of registration, make it look, act, and feel like a regular IPO, and go public? And at first, people laughed at us and said, "Oh, there's no way that, reggae is exactly what you said and flying car nonsense." Well, we ended up doing it. No one listened to us. And we did the very first, which was a company called Myomo. And Myomo is in the biotech, life science, med device space. And it was an enormous success. The stock went from $7.50 to $21 and traded there for 3, 4 weeks and enabled the company to come public. And what it really did, and you hit on it, is that we took fans, consumers, customers, people who had some type of passion for this type of product become shareholders. And what's unique is you're not relying on institutions, you're relying on thousands of investors who are buying $500, $1,500, $2,000 because they actually believe in the company and they want to make the company a success and support it by financing it. So when the company comes public, you don't have people that are hedging it. You don't have flippers. You don't have IPO whores or whatever the term you want to use. You actually have passionate shareholders. And we replicated this numerous times. We did the next one, which is called Monogram Orthopedics. And the beauty of Reg A is you can do traded or non-traded. So on Monogram, we raised over $30 million as a non-traded private company using Reg A. And what Reg A allows you to do is full general solicitation and being able to use modern techniques, which S1 unfortunately hasn't modernized. When you do an IPO, your underwriter will take you around, do road shows, and you can't leave behind materials. You can't have webinars that are recorded. It really doesn't make sense in a modern world where people are communicating real time with their phones. Reg A allows you to be loud and proud and use full general solicitation that you can record a webinar and allow the investors to go back and listen to it at a later date and make informed decisions because maybe they missed something when that CEO was speaking and they can go back and listen. You also have the ability to go to a landing page where you can read about all the pros and cons, the risk factors, everything about the business, and then make a decision to invest now. So utilizing this funnel of social media, and what we did with Monogram is then we took it to the next step. We did a crowd-financed IPO onto the NASDAQ and did some follow-on offerings. And then about a year and a half after it came public, 2 years, the company just got acquired for a very significant amount of money. So it shows it works. And we're in the market right now on several life science companies that we talked about. These are orphans. These are companies that got beat up because of structure. Good, solid companies, large potential community that would be interested. And they can now come in because Reg A is also available in a secondary for follow-on offerings with companies that are 34 Act reporters. So don't discount that if you have a company that has some type of consumer focus, some type of opportunity that people can relate to. So Mitch mentioned oncology. Oncology is perfect. Everyone is touched by cancer in some way. So if you can get involved with a community that is passionate about what you're doing and allow thousands, and most of these type of deals have anywhere between 1,000 and 25,000 investors. So the exchanges love it. They know that when they see a Reg A coming, they don't have to worry about, and we didn't even touch upon that nowadays with NASDAQ and the NYSE, you have to present your investors ahead of time for them to make sure you qualify. With these type of offerings, it's the true definition of a public offering because it's diversified with so many investors. And then when you're public, you don't have to worry about concentration from one or two institutions that are dictating the market.
How about the time and expense of the Reg A? How does that
Well, that's another
compare?
misconception. So everybody calls it the mini IPO, and we're not allowed to really self-promote here, but our IPOs or Reg A's are bigger than any of the biggest IPOs on the street. So mini is the wrong word. And there's a misconception that this is a very inexpensive, non-reviewed product. The reality is this is a public offering onto the New York Stock Exchange or NASDAQ. It goes through a full review. So you can expect to see a little faster timeline than a traditional IPO, but you would be really looking at something in the neighborhood of 90 to 120 days to clear the SEC. Sometimes it happens faster, but the reality is you still go through FINRA, you still go through the exchange process. And then you have a marketing period that happens. So the company, the difference between an IPO in an S1 fashion is you go and do a roadshow, you have a pricing call, you take down, and then you start trading. With Reg A, you actually have a fixed price deal, which comes with responsibility. So you have to price it that it will be accepted by the street and not too high, but at the same time, you don't want to price it too low. And then the SEC gives you the permission to go out and you begin marketing. So you market for 30, 45 days. And what's nice as a CEO is you don't have to worry about a market out issue. You don't have to worry about changes or the bait and switch that most S1s happen. By the way, the banks, we're not doing anything wrong. It's the reality is the investors will give you price discovery where the banker thinks it's worth this, but the street's going to give you that. With this, you have a fixed price deal. So throughout the entire 45-day marketing period, money's being put into escrow. So you know exactly where you are. So when we go to have the final closing with the exchange, the 15, 20, 30, $40 million that's in the bank account, you can actually have confidence that when you have closing, that money will be released to you. And there's no timeline. So you can continue to market until you get to the numbers you want.
If you never get to the number that you want, can you structure a rolling round? Like if you disclose that we're going to start to deploy capital when we raise half of the expected proceeds, is that possible?
You can, and now it's a unique situation because the qualifications to list on the exchange still require that balance. So we have in a real life example, we actually refiled yesterday. We've already raised over 35 million. We've bumped it up to be 40 million so we can go on to the NYSE. And we took a continuous close offering and converted it into an IPO, and they accepted that methodology. So it can be done. But what's important is that the investors understand that if they're investing in a company that doesn't go public, then that's not, you have to be accurate in your disclosure and accurate in your communication because these investors do want to have an exit to somewhere. What we usually recommend is you do a non-traded to begin with, allow the company to get to the advanced stages that it needs, that it will be then comfortable to do the next round. So when they come public, they'll have enough capital to operate and execute that phase 3 or whatever next stage of their growth is going to be.
Okay, well, that's helpful. Look, I mean, we're really scratching the surface with all these strategies. And as I mentioned when we started the program today, people who are attending should reach out directly if they have additional questions. Why don't we just dive into some Q&A here? I saw there was one question about like specific skills that a management team should have. If you are a biotech or really any company, what do you sort of need out of management? What are investors looking for in a team that could bring a deal public successfully? Who wants to take that one?
I mean, I could jump in for a few minutes. I think all of us should really jump in, and definitely the attorney and the banker perspective. I mean, listen, what I would tell, first of all, you touched on something earlier, Steve, about time management and biotechs when they go public. It takes away from the business. Any company, whether you're a biotech or not, if you want to be a public company, there's a risk reward. You're going to have to spend time. I mean, you're going to have certain people within that organization, sometimes the senior people, who have to spend time on the public aspect, not the business aspect. So that's one thing I wanted to bring out for obviously the audience. But no, listen, any public company, and this includes obviously specifically biotechs, it always helps from management, from a skill standpoint. You always have to have a qualified CFO. And usually if you have someone let's work with a public company before it's tremendously helpful. You don't need that, but that's extremely helpful. I mean, I would say just a general concept, and you can't always get there, but there's two things I look at. You have to have experienced executives, but also a lot of our public companies and sometimes the biotechs, they get strategic board members. Okay, you do need a board member with financial experience to run the audit committee, but people who can get yourself into the areas that you have to get into because they have experience in a certain biotech area. So let's assume it is oncology, as Mitch touched on a lot. People who have relationships with certain types of hospitals, that can definitely make those relationships. So to me, when it comes down to management, I look at it two ways: the executives. From the financial end, if you have a CFO that has worked publicly with another company, whether it's in biotech or not, extremely helpful. And any executives that have touched on public companies have had access. But I also think the board is very key, where you get strategic board members. So I'm just at a very high level, because I know we're running out of time. That's my initial input on that.
Okay,
I, I,
please.
I would just say, and again, a lot of this is from my vantage point working with these companies. I take the science for granted, right? The science has to be there. The scientists around the science have to be there. What I'm looking at for these companies is management that are capital market savvy. Because if they're not capital market savvy, they're like a babe, ready to be slaughtered, right, by the parasites that flock to this space, right? They'll go into the cycle that Mark was talking about, which is they'll do one raise after the other, highly dilutive. They'll be locked into exclusives with certain bankers. It'll be the same funds that come in and out and basically extract their pound of flesh out of this company, and they'll be sitting there hoping to avoid a delisting, right? And it could be great technology, right? It could have great patents, could have great medical people associated with this company. We've seen a lot of that, right? We have anyone who's been doing life science space like in these markets have seen a lot of that. But what we have seen is we've seen a lot of them get slaughtered. And so I think having capital market savvy, a real capital market savvy person in this company, leading the charge in that company, it's a real differentiator.
Makes sense. Makes sense. Okay, well, before we close up, let's just spend a couple minutes on direct listings. In this space, for life sciences companies, is it viable? You do it with a pipe? Have those deals happened? Is it theoretical? Like, who's got any, experience with the direct listing, in this
Well, you have
space?
to have that shareholder base. How do you have a shareholder
Yeah.
base when these are tightly held companies? So
Yeah.
you have to meet the conditions to list. So it's unlikely that an early stage biotech is going to have the diversity of a shareholder base in order to be able to qualify.
Yeah, you need
Top of the capital
need
base and assets.
yeah, you need 300 or 400 shareholders based on which exchange you're on, round lots. So exactly, and I think that's one of the really big issues. I've not done a direct listing of a biotech. I will say that, Steve.
Mhm. Okay. Well, I mean, look, as we said, we were going to kind of downplay that as a strategy specific to this sector. So I mean, I think we kind of covered, the topics again, high level. Strongly encourage attendees to reach out directly to our webinar participants. I want to thank Mark, Rich, and Mitch for participating today. PJ Daniels here is going to close up our call. And, want to wish everybody a happy end to their summer. And hopefully we'll see you guys at a Deal Flow event real soon. PJ, it's all yours.
Thank you, Steve. Just following off that, I'd like to thank everyone that joined us on the webinar today and our panelists, Mark, Mitch, and Rich. I think we all attending, I learned something from the event, so I'm super happy and grateful that you guys came on. Just as a reminder, we do have those two upcoming conferences later this year, the PIPES conference and the Private Credit Sourcing Conference. I did put those links in the chat for you guys, so if you're still in here and want to sign up, you can do that by the end. We appreciate everyone joining and hope to see you at one of our events.
Awesome.
Thanks everyone.
Thank you, everybody.
Guys. Take care.
Thank you. Thank you.